the first thing I want to do, of course, is just review the recently posted content. This week we posted presentations on rolling a deep in the money cash secured put. Is now the time for broken wing butterflies, or what strategies might we consider in this market? We had a follow-up to the earnings season hat trick. This one we discussed how to manage and unwind the hat trick for locking in gains going into earnings season. And then we had a discussion on adding a bear put debit to a married put for a little bit of extra profit in those positions. Of course, while you're on YouTube, you might want to check out our playlists that are available. There's a variety of playlists on different strategies, and the playlists are designed to show our shorter, but also our best discussions in a given strategy: call buying, bear puts, bear calls, bull puts, calendar spreads, covered calls, of course, and naked puts, where we introduce the strategy, criteria discussions, tools to use, comparisons of different structures, managing a winning trade, and more importantly, managing losing trades in those structures as well. So you want to check that as well if you're just getting started with some of the ideas and some of the strategies. And let's go ahead now, and I want to move this over. Give me 1 second. This is just a simple asker. Jay says, if a stock pays a dividend when I own or sold an option, what responsibility do I have? Only if you're short stock, Jay, do you have an obligation to pay the dividend. If I sold a naked call, right, I can be forced to buy shares of stock if the stock is be assigned on the call for shares I don't own, which would put me in a short stock position. So I'm selling a naked call, I don't own the stock moves up, I get assigned, and I end up being short shares of stock. I'm essentially delivering shares of stock I don't own at the call strike price. Now, if I'm short shares of stock for that instance, and I cross the ex-dividend date, Jay, I'll have to pay it. But as just the call seller, if I'm not assigned a naked call, you don't have that obligation. If I buy a put and I let it go through expiration, as we were talking about before, for Sal there, and I let it go in the money and it's assigned, well, that means I'm going to be short shares of stock if it wasn't a married put or part of a spread, Jay. And if I cross ex-dividend date in that case with a short stock, now I have to pay the dividend. If you're doing a covered put position, the opposite of a covered call where you're short stock and you sell the put, then that's it as well. You don't have any obligation if you bought a call, if you're in a spread, sold a naked put, for example. You don't have any obligation to the dividend unless some form of assignment takes place where you end up being short stock. The one concern that you might have, or one concern that might come up, is that if you're in the covered call position on a long-term holding, we were just talking about Microsoft, so let's use that as an example. So Microsoft was at 280. I sold the 280 call. The stock ramps up to 285, Jay, and I'm on ex-dividend date. I'd probably be expected to be assigned early. The shares would be called away from me because the person who bought that call might want to be on record of owning the shares of stock to collect the dividend. If my plan was to sell out of the money calls on Microsoft continuously and just collect a dividend-like payment as well as the dividends, selling out of the money calls, Jay, I need to know where the ex-dividend dates are. You need to pay attention to that if that's your approach with a dividend-paying stock, because you don't want the call to be too close to at the money or in the money if you're crossing ex-dividend date, because you might get assigned early, and if that wasn't your intention, that's what you'd have to avoid. But with the options, Jay, you don't have any obligation to the dividend. That's not to say you might not be affected by movements of the stock after the dividend payment, of course, but I know you're aware of that as well. So let's go to Paul now. I just wanted to cover that real quick for Jay. It was a real quick question there. For Paul. Paul says, in some of the forums I'm part of, I've heard that people who write covered calls often close their contracts that are out of the money early rather than letting them expire worthless. Absolutely. What are the factors that one would consider in deciding whether to close a call early and sell a new call? And let me write this down, Paul. We did a good presentation a few months ago. I can't remember the gentleman who asked the question, but he was selling weekly covered calls, Paul. And he wanted to know, hey, is it best if I'm out of the money going into the Friday expiration, should I let that call expire and then sell the new call on Monday, or should I just buy it back cheaply on Friday and roll it at that time? And what we saw was when you're doing week by week positions like that, the one or two example, we looked at one example, we tried to look at a second one, but both of them, it looked like it made a lot of sense following that pattern to buy to close the option. Now, we were talking only about a 3 or 4 cent buyback on the short call that was expiring today that was still out of the money, Paul. And let me go to the portfolio. Oh, I don't have it on here, do I? I don't think I recorded that one. Apologies. Let's go here. Go. I didn't have it. Okay. All right, but that's okay. We'll show a different example of that anyway in a moment, Paul. So where I was going with this is that over the 2 days, so essentially he was buying back one call at 3, and he was going to sell the same strike or another higher strike out of the money on Friday, and then he was going to get about 57 cents of premium. We did this on a historical chart, and then we went forward to Monday. The stock had only moved about 10 or 15 cents at the open, or between Friday's close, Paul, and Monday's close, and the call was only worth 46 cents. It had dropped 9 cents roughly, because the 2 days of expiration, now this was going to expire that Friday, so it went from 7 days left to only 5 days left. You lose the 2 weekend days there, Paul. And it made sense to buy it back for 3 cents to get the 9 cents more, because you're still positive 6 cents. If he didn't buy it back for 3 cents, it got 9 cents less. He lost 6 cents. So I know that's splitting hairs, Paul, but that's what you do. Now, typically, when we're in these type of positions, let me just go back to this one. Let's see if we had anything expiring the 29th. I did. These are all May expirations. None of them are really, this was something we did for Tesla, but here's sort of what I would look for in a covered call. I'm going to use AIG. That's the married put I have, but we're going to do a covered call. And my cost basis is different. That's fine. 100 and whatever. The 11th, I've been in this position much longer. Let's say 62.50. And we sold today's 65 strike call for, I'm just showing you what alert I would set here. And I think it was 125 or something like that way back when. All right, so let me just put this covered call in, Paul. Now, what I look at and what Ernie looks at is right here. As a general rule, what this is showing me is my position, of course. Max expected profit of 6%, but I'm losing 4.5% because the stock is down to below 60 now. But on the call premium, we took in 125, and earlier this week, I could have bought it back for 5 cents or 7 cents. Right now, if I bought it back for 3 cents, I've made 98% of what I expected to get. A common approach, Paul, is to close or roll the sold call in a covered call, the sold put in a cash secured or naked put position if your option has reached 80% of its expected potential profit, 80 to 85%. So I'll set an alert here on these positions to be notified if my option percent change increase 80%. Or I could set it by delta or the percent in the money, percent out of the money limit as well. Okay, so that's just the alert I'm going to set on the option leg to be notified. And I did do that wrong, didn't I? The wrong thing. Sorry. Decrease. I'm so used to doing it with the bull put credit spreads. I do it wrong when I put it in the alert for the covered call position. There it is. Okay. So now it notifies me that I've made the 80% profit. The call has declined 80% in value, but that's 80% profit to me. And that's when I would look to roll the position. So once you hit 80 to 85% profit, it's probably a good idea to buy it back and roll to that next level you were considering, Paul, to roll out to that next strike, that next expiration, to try to maximize the time value of the new option that you're getting rather than wait the 2 or 3 or 4 more days to expiration if you've already made 80, 85, 90% of what you expected to make on the position. Okay, and so that's what we consider, Paul, in those cases, and you can use the portfolio there to set the alert. And I'm writing down a note here, Paul, to send you the email with that better example that we had. We went back historically to look at rolling, and that was a weekly discussion. It wasn't monthly, it was a weekly discussion. But yes, if I did a monthly call, if I had sold the May 20 call on AIG here, if I had bought the stock at 62.50, sold the May 65 call for 210, and now with still having 20 days to go to May 20th expiration, 21 days to go, with the stock at 58.51, I want to roll down for more protection. If I've reached 80% of profit, the buyback cost is only, say, 25 cents. I'm going to buy it back at 25 cents and now look to sell maybe a 60 or a 62.50 for May or June to get that new higher premium into the position. But that's usually the target they're talking about. You could use delta as well. If the delta drops to, say, maybe 0.2 or 0.3, probably lower than 0.3, probably 0.25, 0.2. But it's just easier to look at the profit you have on your original sold call. If you've made the 80, 85% of what you expected to make, that's usually a trigger to consider buying it back and then selling a new call either at a lower strike, further out in time, roll the position as you were planning with your approach there to get the profit. In that other discussion, we did have a comment there. So if I had sold, for example, Paul, a weekly call on a stock, and I sold it far enough out of the money where I only got 12 cents, 15 cents or something for a weekly covered call, and I'm at expiration, it's out of the money, and it's still going to cost me 5 cents to buy back. Well, I'm not at the 80% profit, am I? Because I took so little premium up front. In that case, I'm probably going to let it expire to maximize that small premium I took on that weekly covered call if I was doing that approach and it was a smaller premium, and then still just continue to sell on Monday as well in those cases to move forward. Okay, so I will make sure to get that presentation to you from YouTube. I'll send you the link to that when I dig it up after the presentation today.